Hi everyone, a very good morning to all of you. I'm Shakti from Grant Thornton Abdullah. Today's webinar is going to touch base with sharing profound knowledge about taxation in the GCC and more importantly in Bahrain. We're waiting for more employees to, more attendees to kind of touch in. So just a few minutes so that, more people could join us. Amidst that, I would also like to inform all of you before we proceed any further, just a basic set of housekeeping protocol. I'd like to remind you all to please ensure that you guys stay on mute and also ensure that you don't get distracted. For questions, please ensure that you make use of the questions tab or bar at the bottom right of your corner. The next thing is, I would also like to remind everyone that we are open to questions, both in the English and the Arabic service line, as we have an Arabic tax expert with us, and Mariam Marhoon, who can answer your questions in Arabic as well. So that would be the end of this webinar. The question and answer round will probably last for about 20 to 25 minutes at the end. With now attendees coming in, I think it's a good time to start. So I would also mention that it's a key highlight to have all your email addresses when you're posting your questions in the question bar, so that we don't lose out or we don't lose track of the people asking questions. So in case we run out of time, that is. And in today's panel, we have Mr. Jatin Karia, the senior partner of Grant Thornton, Mr. Mohammad Naveed Rashid, and Ms. Mariam Marhoon, both the tax subject matter experts. And the agenda for today, as you can see on the slide, is basically going to touch base with the background of what's happening in VAT with regards to GCC, how about the basics, the considerations, penalties, and the compliance with regards to COVID-19 and the way forward. And the most important substance of today's takeaway would be the newly installed economic substance regulation that has been hitting us for the past nearly 2 months. So that is one thing that you all want to kind of pay attention to. And without any further ado, let me hand over to our firm's senior partner, who will start things on how taxation and future compliances have played a role amidst this pandemic. Over to you, Jatin.
Thank you, Shakti, and good morning, everybody. I hope you all are doing well, and as a part of the Grant Thornton continuous commitment to provide the knowledge-based series, this is our 4th series. Prior to that, we had given something on cybersecurity, on the corporate restructuring, on the risk part as well. So I'm very much thankful to Naveed and Mariam to make themselves available for this series. Now, compliance, we all know it's a very heavy word in this part of the world, especially where we face never any situation of having a tax and any other sort of the compliance. I still remember that whenever people move from Middle East to India or other part of the developed world, they always say that you are not aligned with the requirement of our culture, because you are coming from the tax-free country and you might not be a technically sound in tax and compliance aspect. We are gradually moving on compliance era. To start with, the government had introduced VAT. Subsequent to that, there was also a PDPL, and now the economic substance regulation. My humble request to all the corporates or the people who are right now attending the seminar, that instead of just getting scared of compliance, we need to understand the objective. That what is the objective behind this law? Whether it's a VAT, yes, the government would like to collect more revenue. It's more kind of a bottom-up approach, where instead of only pumping money from the oil economy,
Webinar.
Possible to give you the answer right now, we'll make sure that we'll send you through email. Again, thank you very much, all of you, to attending this webinar. I'll hand it over to Naveed and Shakti to take it forward, please.
Yes, thank you. Okay. Thank you very much, Mr. Jatin. It was really insightful for you to share your thoughts about the current legislative process and how the perspective of GCC is now changing. We can surely say that we are no more into the tax-free havens. Things are changing, and most likely we will be coming into tax nets with the international standards, things which are already there in the international market. And we really hope that we will have better compliance, better regulator, and better mode of operating things, which we'll see in the coming days. So that is something we all aiming to. So we will proceed with the webinar. As Shakti and Mr. Jatin has said that this webinar is about mostly compliances, and you're already aware that there are two compliances which are already in the queue in the market. One is an already well-known VAT, which is in the market, and it has been maturing enough, and it has been almost 1.5 years for it to get matured. And we have seen a lot of things coming out, the regulator maturing it, the regulator issuing its guidelines, clarifications, helping out the market to see how they can help out in making this a documented economy. So that's really good thing from the regulator part. So we will be touching from the regulator perspective, we will be touching the VAT perspective, we will build a scenario from the VAT basics to the technical things, and then we will talk about the hot topic of the time right now, which is the economic substance regulation. So without wasting much time, we will proceed further. I will be joined and I'll be assisted with Ms. Maryam Marhoum. She is a subject matter expert in VAT. She is handling some big clients in Bahrain. She is well educated and she's well equipped with the VAT knowledge. So feel free to ask any questions. Don't get hesitant, and if you want to ask questions in Arabic or in English, we'll be happy to answer you. So we have devised the format that we will take up all the questions at the end of the session, just to avoid any interruptions. We hope to cover as much as we can. So stay up, stay tuned. We can start now. So VAT. So as you guys know that VAT has already been in the place for the last 1.5 to 2 years in the region. So we'll start with some of the background of the VAT in the GCC region, just to give you a refresh you how things started and how things end up and where we are standing in the region. So the VAT started in the GCC back in 2016, where the VAT agreement was signed with all the GCC countries. As you know that we are already aware of the agreements. So the agreement was signed, principally all things were agreed upon, and the member states were given the power to set up their rules and regulations for all those things which were not discussed in the VAT agreement. So the rate was already defined, which was 5%, and it's referred to most of goods and services. And the registration thresholds were also established in the VAT agreement, which was equivalent of $100,000 US. So we have just prepared a summary of current developments to date in the market in all the GCC states that will come up in the next slide, and you can see that where does Bahrain stands in comparison to the other 5 GCC countries. So we can go to the next slide. So here's a synopsis of the GCC VAT developments. So if you see that Bahrain, Saudi, and UAE have already implemented the VAT, and Oman, Kuwait, and Qatar are still stacking behind. We are getting some news that Oman and Kuwait are expecting to have their VAT being implemented in the mid of 2021. So we are waiting for it, but Qatar is still out of the picture, and there are no confirmations from the Qatari government on when and how they will be implementing the VAT. Few things which we have identified and we wanted you to mention, that despite the fact that there has been a common VAT agreement, the countries are taking up the initiative and they are changing their national legislations for their self purposes and for their self efficiencies. We have recently seen that Saudi Arabia has changed the rate of VAT and has raised from 5% to 15%, which you can see that it is applicable from 1st July 2020. This is an exact explanation of how they are relying on the indirect taxation, and this is a testimonial for all of other countries to take this thing seriously, that as the market participant usually replies that 5% does not make any difference, but 15% will do. As your neighboring partner, as the leading country in the region, they have escalated their rate from 15% to 15% without even changing the VAT agreement. It is clearly an indication that all the other member countries in the GCC would likely to follow the same if they are forced to do that. So we will be discussing a lot about the potentials, the comparisons which are being there in the Saudi, UAE, and Bahrain, and especially the countries which are developing. So just to give you a highlight, that Qatar, Kuwait, and Oman have already ratified the VAT agreement, so they are committed and they have agreed and approved the VAT agreement, which was agreed in 2016. So they are coming into the way. You guys already know about the VAT requirements in Bahrain, Saudi, and UAE, and you can see that there are multiple. There are substantial differences based on the turnovers. In Bahrain, there are monthly, quarterly, and annual requirements. You can opt for any of the one if you're falling in any of the categories. In Saudi, there are only two, depending on the revenue, 40 million and less. And in UAE, there is one which is quarterly, and you can go for another time period depending upon your requirement. So this is just a synopsis of what is going on in the market. We'll proceed with the Bahrain VAT from the slides next onward, and we'll build a scenario of starting from the basics to the technical to discuss about how the VAT works in Bahrain and what are the things you need to see when the regulator is looking for more documentation, looking for more scrutiny of the information which they are expecting in the coming days from the market participants. So going to the next slide, just a couple of slides, just some basics. As VAT, you know that VAT is just an indirect tax. Can you go to the next slide? You know that VAT is just an indirect taxation. It's based on the consumption model. It's a multi-stage tax, and it's largely based on destination. And one misconception about the VAT is that this is not on profits. Why I've put this slide here to give you an idea on this is a consumption-based tax, because now the businesses need to be very careful in deciding where the consumption takes place. So if you are having a business in Saudi Arabia and you're having a business in Bahrain, those are connected. So now there are two different VAT rates which will be applicable from 1st July and onward. Meaning, if you are doing and consuming the services in Bahrain, that is 5%. But if you're using and consuming services in Saudi, they are 15%. There's an escalation of 10% differential between the Bahraini and Saudi. So that is quite a substantial amount to look from the business perspective. So the businesses need to clearly identify that where their destination base, where their consumption of the services or the supply of goods is happening. For that, we need to see the basics, and then we have to build up the business model depending upon what are the merits and what are the requirements of the business and where they need to establish. When you go to the next slide, one of the definition of the taxable, one of the definition in the VAT law is the taxable person. And one big misconception about this is that only those businesses who are registered are called taxable persons. We just put this example to give you an idea on all those businesses which are working in Bahrain to look into the definition and evaluate whether themselves or any of their subsidiaries or any of their SPC or any of the individual working in the capacity as highlighted or as identified in the VAT law, it can qualify to be a taxable person. So just to narrate the example, just to narrate the definition of taxable person, includes both legal and natural person. So my friends, all those people who are carrying out any economic activity in their capacity as an individual, a company, a partnership, an SPC, a WL, a BSc, they are all required to get their evaluation done, whether they're required to register or not. Registered and registrable is the second tab and second requirement for the taxable person. So if you're already registered, you should already hang up with the tax registration certificates. So you come into the ambit of registration. You are coming under the ambit of the taxable person. You are required to register. So the third thing is that you must be making taxes. So you are the goods and services are being provided which are not otherwise relieved from VAT, you should be looking into it. So we will talk about the type of supply in the later slides. But if you're making a supply of goods and services, you have to see your potential of getting registered. And the last thing is the course of you're doing these activities for the furtherance of your business. So it should be a regular business activity with sound business principles with a view to make profit. You may or you may not end up in profit. So I'll give you an example. Like suppose if an individual who's not a registered person, who's not a legal or corporate person, if he's doing some activity on a basis which is for the purposes of making profit, and he's doing on a regular activity, despite the fact he's an individual, he may end up in getting registered. So it includes all freelancers. It includes your professional people who are accountants, doctors, architects, engineers who are working in the individual capacity for the worker. They need to see whether there are any registration requirement for them on the current date or not. So if you go to the next slide, this is not relevant right now, but the point of putting this slide, the next slide is that we want to see that what were the registration requirements in the region which was there, which were implemented from 1st January till to date, and we need to see who and what there were people who are required registered. Pratik, can we go to the next slide? Can we go to the next slide, Chip? Okay, so one where the businesses are required to register in different dates and all have been done. The point so the registration threshold you see in the table above, they are only for the resident businesses. So I'll give you an example. Let's suppose if a business who is registered in UAE and they are providing services in Bahrain, so they don't have to, and they don't have any legal registration set up in Bahrain, and they're providing services to people, the common people, or into a B2C transactions. They don't have to look into the thresholds for determining their registration liabilities. They are required to register with the NBR from the first day they make first fill of supply to Bahrain. That's a misconception which has caused, we have seen a lot of businesses who have faced a lot of penalties just because of the case, because they were unaware and they were just waiting for their threshold to meet, like there is an option in the Bahrain white law which allows that if you are making more than 18,750 but less than 37,000, that you're merely meeting up the mandatory registration requirement, you can still register by a voluntary registration option, and you can go and register on the NBR. The process are already defined in the NBR. It's very self-explanatory, and anyone can follow that. Can we go to the next slide? So having discussed about the VAT registration considerations and about the taxable person, we will move on to the next slide, which is about Shakti, can we move to the next slide? Time of supply. Next slide, please. So next slides. So we have been talking a lot about, so the core or the basics of the VAT law here is that what is the supply. So I mean, this is the basics. You need to understand the definition of supply, and it covers few some orthodox and some special things which were not in usual scenarios being taken as a supply, but they have been made part of the supply definition, and they should be considered when you are providing those services. Supply means all forms of supplies, which includes goods and services, including imported services, done for or not consideration. The supplies of good means any supply where you are transferring the ownership and ultimate title to someone else. So this is different from the services. So anything which is not a supply of good will be treated as a supply of services. So there is the differentiation has to be made, because we will deal about these things in the later where the deeming rules come into play, that you need to define whether you are providing a good or a service. So as we said, that part of the supply definition is that it should be for a consideration. So anything which is for a consideration means anything that is received or expected to be received in return for provision of goods and services that is linked to the supply. There is one exception to that, that there could be supplies for which there is no consideration received, but still they will be subject to VAT, or they are within the ambit of VAT, because they will be kicked off by the deeming rules. Now, certain supplies do not qualify to be supplied because of the nature, because of the transaction, and they have been specifically excluded from the list, like transfer of going concern, providing of services by the government. These things are out of scope from the value of from the VAT in ambit, and we will deal with some of these examples in the coming slides. So having said so, what is a supply? Now we will talk about what are different kinds of supplies which have been identified in Bahrain VAT. So as you guys already know about this in detail, there are technically 4 different kinds of supplies which are identified in the VAT law in Bahrain. Starting from the most right, there are exempt supplies, there are zero-rated supplies, and there are standard-rated supplies. Exempt supplies are those which have been categorically defined as those supplies which include financial services, which are interest-bearing, margin-based, shares, derivatives, and supply of real estate of residential and commercial properties, including supply of bare land. Zero-rating supplies are those in which are taxable supplies, but they are subject to VAT at the rate of 0%. It's a quite long list, and I would say that if you guys are having business in the GCC, this is the biggest list which was provided by any government in the region, and we pay a lot of tribute to the government of Bahrain, that they have been really kind enough to provide a lot of relaxation to the basic commodities or the basic businesses of the people in Kingdom of Bahrain. So if you see that the VAT impact of most of the services will fall under zero rated, will have no impact, because they will be just the documentary purposes, and the VAT rate is 0. It includes most of the government services, qualifying medical services, which are healthcare services, transportation services, local, international, oil and gas, education services, investment for metals, export, basic food items, and certain GCC supplies, and new construction services. So if you see that, it usually covers everything which is there in Bahrain. Apart from these 2 on the right side, everything else is subject to tax at the rate of 5%. So these are 2 exclusions. If you do not fall under the exclusions, everything that you supply or you make as a part of your furtherance of activity will be subject to VAT. So these 3 categories, there is another category which is out of scope category. So we have just made a summary, the next slide, so you can see that what that means. So the next slide shows that the type of supplies and the VAT rate which have been there. Shakti, can you go to the next slide? So the 4 types of supplies are standard, zero, exempt, and out of scope. As we discussed that the first 2, which are standard and zero rated, are taxable supplies, and the last 2, which are exempt and out of scope supplies, they are no VAT supplies. But there is a kind of difference between all these 4. If you see that the first 2, they are taxable, and any VAT which you incurred in making those supplies, the VAT that you pay to your supplier as a cost, you can recover it in a full. But for an exempt supplies, you cannot charge any VAT, and you cannot recover any VAT. The first 3 ones, the standard, zero, and exempt supplies, are the reportable items in the VAT return of Bahrain. The last one, out of scope supplies, are those which are not within the ambit of the VAT. It includes usually the government supplies or the supplies which are not subject to VAT in Bahrain. You are not required to report these The VAT in respect to some of these services can be claimed, but depending upon the nature, we will discuss about this in detail in the next coming slides. We'll go further. So having talked about the basics about VAT, now we'll go into some complex areas which involve the place of supply rules and how you should be technically doing the supply rules when you are working or you are doing business in the GCC concept. So the general concept which was provided by the VAT agreement was that in case of the supply of goods and services, you have to see the place of consumption of the goods and services. So we have just gave you an idea about the place of supply rules for goods. So just to elaborate that, if you are making a supply or delivery of goods within a GCC country, it is the country, the GCC country will be the place where the goods will be consumed. So if you are making a supply of GCC in a B2B transaction, the place of supply will be the final destination place of the member state, so where the goods are landing. So where you are, but where you are making a GCC supply in a B2C transaction, so you are registered, the other party is not registered, the place of supply will be the place from where the goods are originating until the thresholds are breached for the member state of destination. This is quite complicated. We have prepared some slides on this topic in the coming few slides, but just just keep this in your mind that you have to see certain threshold requirements when you're making supplies in the GCC region. If the delivery of goods is outside to the GCC customers, then the place of supply will be in the member state of the dispatch. So if I'm making goods being exported from Bahrain to Switzerland, my place of supply will be where the goods transportation has started. But since this is being consumed outside of Bahrain, so the VAT rate of 0% will apply. So coming to the services, the service rules are a little different because, as you guys know, that there is no trail of services in the region. The goods do pass through customs area, and there is a physical trail that you can verify where the consumption happens. But in services, unlikely this is not possible. So for services, there are certain guidelines which have been given by the VAT law and the VAT agreement, which says that if you're making a B2B transaction for services, the place of supply is where your customer is located. So if I'm providing a services in Saudi Arabia, I'm a registered person, I'm providing some services to a customer in Saudi Arabia, the consumption will be in Saudi Arabia and the place of supply will shift there. So I have to see my VAT implications from the Saudi perspective. But if I'm providing B2C services in Saudi Arabia, then my place of supply will shift from the customer and will come back to the place of supplier where it is located. So in case of B2B, it is the customer place, and in B2C, it is the supplier place. There are certain exceptions to these rules which may apply if the services are in relation to some real estate or in relation to a location which is present in a region. So we just exclude the real estate services and electronic services from these kind of this law and this grid of service sector, because they are special place of supply rules which override the general place of supply rules and will be dealt according to the situation on case-by-case basis. Now, moving on to the next slide. Before we do that, there's a concept of electronic services system. So to give you an idea on what is an electronic services system, so when the VAT agreement was signed between the 6 states, the initial idea was that so the GCC would be taken up as one unit. So when they say at one unit, the main idea that all the trade which is happening inside GCC should be disregarded and should be taken as one trade. It's just like a group trade within a group. So the idea was proposed at the time of the VAT agreement that all the countries, once they have implemented the VAT, they will be connected to the ESS system, which is electronic services system, and they will report each other state's transactions so that there is an avoidance of duplication of transactions, and only the VAT is collected on the consumption basis, which happens. So we have just made a summary of a few technical ideas here, that how things will be right now, things are right now, and how things will be when all the states will be implementing VAT. Shakti, can you go to the next slide? So the cross-border supplies of goods before ESS is pretty simple. As you know that if you're supplying goods in Bahrain, it is a standard consumption which is happening in Bahrain, so it will be subject to Bahraini VAT. But if you're supplying goods to anyone outside of Bahrain, then it will be subject to VAT at the rate of 0% based on the consumption rule. In order to avail the zero rating, you need to just prove that the goods were exported outside to Bahrain within 90 days, and you have all the export documentation which were issued to you by the by the customs department or by any other regulator who is required to do that. If you go to the next slide, but if you see that once the ESS kicks in, the whole scenario changes. Now it becomes quite complicated, and it will add, then there will be more complications when there are different rates. So I'll just walk you through what is what would go when you are looking into the different so the consumption remains in Bahrain, so it will be subject to Bahraini VAT. But if you are making any delivery to a GCC customer, now you have to see that whether the customer is registered in his region or not. If the customer is registered in his region, that he's a Saudi customer, he's registered, then the supplier who's in Bahraini will treat that supply as an out-of-scope supply, and it is not required to be reported in his VAT return as of now. Maybe there's some other requirements at that time to report these transactions, but as of now, they're not required to report these out-of-scope transactions. Let's suppose if the customer is not registered for VAT, then the supplier who is making supplies to a GCC to a customer in Saudi, then he has to see what is the total value of his supplies it's making in the GCC states. So if the value of supply is less than $100,000 or less than 37,500 dinars, he will still go and charge VAT at the rate of 5%. But if the supply is more than $100,000 or 37,500, then he has an obligation to go and register himself in that region in which he is making a supply and charge that local member country's VAT. That's weird. So let's suppose the ESS comes effective right now, and you're making supplies, Bahraini supplier is making supplies to Saudi customer. So it means that if the supply value is less than 37,000, there will be VAT of 5%. But if the VAT if the supplies value goes above $100,000, so then you will be charging Saudi VAT, which will eventually change in the next 7 to 8 days to 15%. So you have to be very careful that you know the rules of place of supply, because they will eventually shift the consumption from one place to another just depending upon the place of supply rules. Lastly, out of scope, lastly, if you're making supply outside of Bahrain, it remains the same as in previous one. So the Bahraini VAT at 0% will charge. You need to prove to the government that you made actual physical delivery of the goods outside of Bahrain within 90 days, and you have export documentation. Please note, if you cannot prove to the government of Bahrain that, or the regulator, that the goods actually moved out within 90 days, the zero rating option will not be available. The rate of VAT will change from 0 to 5%. So it's very crucial for you to have all the documentation in respect of all those supplies which you are making. Unfortunately, there's a parallel system of supply of goods which usually happens from Bahrain to Saudi through Causeway, and we have been seeing that a lot of businesses have saying to us that we have made the shipment and we did not get an approval and documentation from the authorities because it passed as a personal vehicle when they crossed the border, and now the Saudi government imposed the VAT at the rate of 5%. So you just need to make the system and processes better, because at the end of the day, if you do not have a documentation from the Bahraini government authorities on the export of the shipments or export of the goods, you will end up paying in a VAT, which is a Bahraini VAT, and then you may have an additional cost of the VAT on the importation of goods in Saudi Arabia. That's why these things are very important. You need to define the processes. And my opinion on this thing is that this is relevant to usually the bigger businesses who are into the market and who are having a ongoing trade with the businesses in Saudi, with the businesses in UAE through the land routes. They need to be very much familiar with the time of supply rules, and there should be a request for extensive documentation before making the supply happen. So these were the rules for the supply of goods. We'll move on towards the supply of services. So you'll see a quite shift from the place of supply rules. Shakti, can you go to the next slide? Shakti, can you go to, okay. So we have seen that, we have just talked about that the place of supply rules which are there on the supply of goods from one region to another. So the import of goods, is it a supply or not? So this is a very tricky question. about some industry examples that there's a concept of consignor and consignee, and usually the government people can, the people who are licensed by the government of Bahrain can only clear the shipment from the custom ports. You will see that in this region, a lot of the people, the supplier and the customers are different, but the shipments are being cleared by someone who could be a interim clearing agent, or it could be anyone who can go and have access to clearing the goods. So please, as per the customs rules in Bahrain and as per the VAT clarifications, importation of goods is a supply in Bahrain which does not require two parties. So any person who is there at the customs clearing the goods would be enough for the VAT purposes to make a supply into Bahrain under its own name. So yes, if you import goods into Bahrain, it will be subject to Bahraini VAT, and it will be charged based on the person who presents the documentation for clearing of the goods. The value of the VAT will be charged on the CIF value plus all taxes which are non-deductible taxes. On top of it, there will be excise duty and customs duty. And the total value which comes up and commuted by the customs, then it will be subject to VAT at 5%. Any VAT that you pay on the custom importation is recoverable depending upon whether and who has the import documentation. So there are certain rules which are relevant to the recovery of import tax. We will discuss about these rules just to give you an idea that you should be a registered person, you should hold the documentation, and the supplies must be used for making further taxable supplies. Only then you can recover the VAT, and the items which are importing should not be specifically blocked for VAT. So we have, I'll just share an example in which one of the company in Bahrain, they imported a very big consignment, and since the contract was not in their name, so they let another party to do the shipment. Now the revenue which was generated afterwards were parked in the company which was making the supply, but eventually the cost was not under the name because the custom department documents were issued with someone else's name. That caused a huge cash flow issue because there was no matching concept between the revenue and the cost. One revenue was parked in another company and the cost was parked in another company because the shipment was cleared by someone else. The legal ownership of the customs importation goods went to someone else, and that ended up in quite a big headache, because by legally, if you're not the ownership or you do not own the ownership of the documentation, you cannot claim the VAT in your VAT return. So now coming to the service rules, which is in the next slide, you see that currently before ESS, the services rules are quite simple, and it depends upon the contractual recipient, as we have mentioned in the first, in the third or fourth slide, that for services it depends upon if in B2B transaction, if your customer is registered, then it's the place of supply where your customer is located, and in other cases it is the place of supply of your supplier. So if you see that if in case of supply, you have to see the location of your contractual recipient who is actually receiving the service. So if the services are being received in Bahrain, the Bahraini VAT will apply. That's 5%. But if the services are not received in Bahrain and outside of the Bahrain, you have to see that whether the services are in relation to any goods, land, or property which are situated in Bahrain. If the answer is yes, it is related to any of these foregoing things, then the Bahraini VAT will apply. So, give you an example. Let's suppose there is a property located in Bahrain, and you hire someone to do an blueprint drawing, or you hire services of an architect. That architect provides you you provide the services for that building to someone who's located outside of Bahrain. Since the building or the goods on which your services are being provided are in Bahrain, you cannot technically zero rate the same. You should have to apply, because the real estate services are located in Bahrain, and any services located in connection with the real estate services cannot be separated from the principal thing which is there in Bahrain. So the VAT of 5% will apply, and you will have to charge Bahraini VAT 5%. It is irrespective of the fact that the customer who is taking up the services is outside of Bahrain. On the other case where the property is not situated in Bahrain, so we have to see another test about the benefit of the services. So if the benefit of the services is not in Bahrain, I mean, if no beneficiary is taking benefit the same, then the Bahraini VAT will apply, but it will apply at the rate of 0% because you can prove that the consumption took place where the customer was located. So that can be zero rated and can be dealt as an export of services under the Bahraini VAT law. But if it is proven that the benefit of the services you have provided to a customer who is located outside, and that benefit was availed in Bahrain, now things will change, and for services the Bahraini VAT will apply. So you see that there are a lot of things which are pulling VAT at the rate of 5% into Bahrain. So you need to be very careful in seeing that what services you are providing and where the services you are providing are in respect of any exclusion list which have been provided in the VAT law. So as of now, this is the scenario. If you go into the next slide, once the ESS is there, we see that things change quite a little bit. Kathy, can you go to the next slide? So after ESS, some of the things will remain the same, but few things will kick in. So if after the ESS is there and I'm supplying services for which the contractual recipient is in Bahrain, Bahraini VAT will apply. But if the participant if the customer recipient is in GCC, we have to see whether that recipient is registered or not registered. If he is not registered, then you will have to apply VAT at 5%. And if he's registered, you have to do an out-of-scope transaction, will not reportable. And he, as a customer, will have to account for under the reverse charge mechanism, self-account by customer. We will deal about this thing in the coming slides. For out of Bahrain transaction, it remains the same as we discussed previously, that this will be subject to 0% if it's proven that it's not respective of any goods and services located in Bahrain or benefit is not consumed inside Bahrain. One catch here, which I just wanted to touch here, that you see that when the customer is in GCC and is not registered, the Bahraini VAT will apply to the extent of 5%. There is some confusion regarding this thing because the threshold requirement of $100,000, if less than, then VAT will apply for Bahrain. If more than, the region will apply, was as per the VAT law is only applicable for the goods. We are not sure right now that whether if ESS comes in, we have to see the registration thresholds for services also in order to get registered in other member state for charging and collecting VAT in that state if required by the law. But we will leave that because we don't see as a consultant that the ESS is coming too quickly. It still requires a lot of time because we see three states being still far away from the VAT implementation. So and once they're all in into the GCC net, then only these things will be valid. But we should be familiar with the scenarios when the tax rates are changing. This is something because this requires a lot of integration into your systems, and we are advising that the ERP implementation and things should be done properly one time, because if you keep on changing, it may end up in messing up your own system. So we'll go to the next slide about the topic of out of scope or self account for, which is called a reverse charge. So this is quite an interesting topic, and it is there in the quite well used in the international taxation in the mature associations. The services relating to the place of supply, when you are importing services, it's quite a big thing because the VAT law which has been brought into this region was actually taken up from the EU model, where the EU was working as a one unit and they were all integrating the VAT and they were just cross-checking each other. So to give you an idea of reverse charge is something, I think I will explain this thing with an example. So reverse charge is a kind of a concept in which the customer who is importing a service will charge himself a VAT and then take a credit of that. So I'll give you an example. Let's suppose I am a supplier, I'm a customer in Bahrain, I'm a random person, I'm a VAT registered person. I intend to import to take the service of, let's suppose, management services or management consultancy services from someone. I have two options. I can either go into the market, the local Bahraini market, and look for a supplier, or I can go and look for an international supplier. So let's suppose I take quotations from both suppliers, and both of them give me a quote of 100 dinars. So they give me a quote of 100 dinars for the value of services. Now I have to see from where I have to get services. So if I do a cost analysis of both the quotations, I would have got a 100 dinar value supplier plus 5 VAT service from the local supplier. But when I'm getting a quotation from the foreign supplier, the service which I'm getting is 100 dinar. So I, as a business person, as a rational business person, will definitely would want to go and save some money, and I'll go to the 100 dinar foreign supplier. So Bahraini government or the lawmakers here saw this thing coming, and they knew that if you are not putting a watch on this scenario, the system will be abused, and the businesses in the local market will not get enough business because people will rather go to the foreign supplies, which will be 5% cheaper at the time in comparison to the local market. So they bring in the concept of reverse charge. Now, the reverse charge means that if I'm importing a service from the foreign supplier for the consultancy service, the cost of the service still remains 100 dinar, but I, as a customer, will have to do the reverse charge calculation of the VAT. So I will be deemed of supplying myself the services and charge me VAT at the rate of 5%, but then instantly I will be claiming that VAT which is being charged by me, by myself. So it gives me on the same level feels like if I get a local quotation, I would have been quoted 105, for which 5 would have been my VAT input. Now I'm on the same level field. So it makes me no difference to evaluate or go for a cheaper option just because of the VAT as a key factor. So if I'm into 100% taxable business, this reverse charge of imported services will just mean to me an accounting entry which will be just be reported in my VAT return and nothing else. It will debit and credit and it will all go away. But if I'm into a mixed supply, that I'm having on exempt supplies also, in which I cannot charge VAT, my input recoverability will be affected. To the extent of I cannot recover, I may have to make payments to the government to the extent of import of services. So this is quite different from the 100% taxable business, but the whole idea behind this is that you need to have you need to bring in the documentation of all those transactions which are happening, which were outside the ambit of the Bahraini VAT. There's a little concept on domestic reverse charge also. So the domestic reverse charge, as of now, has not been kicked into. There have been some news that the Bahraini government will be announcing some approvals for using the domestic reverse charge, but there's some criteria to that, in which the local suppliers and the local customers can agree, in which the customer who's buying from a non-registered supplier could do a reverse charge domestically. So he can charge himself and then claim VAT. This is the kind of arrangement in which the registered persons are made obligated to include in the undocumented transactions, so that they report it and claim it, so that the suppliers who are not so far registered in the VAT, they become reported in the VAT returns, and then the authorities can take action further. So this is not right now approved or effective as of now. There could be some special cases, but that are approved on case-to-case basis. Can we go to the next slide? So summary to that is that it applies only to the imported services right now. As we said on the cross-border transactions, that intra-GCC imports of goods will come into, but only after the ESS is there. The criteria must be that it's a local person and place of supplies in Bahrain. As we have already discussed in detail, that this is all to cover the local and to provide some protection to the local suppliers in respect of the services which are being imported from outside of Bahrain. So this was more like about the import of the reverse services. Can we go to the next slide? So we have talked about where you are required to be taxed. So now we talk about when you are required to pay tax. So the rules are in respect of the time of supply rules. So the Bahrain VAT, as you guys know, that have broadly defined the time of supply rules into two main categories. One is for the discrete supply and second is for the continuous supplies. So the discrete supplies are those which are one-off supplies which happen under a contract or under any memorandum, in which the supplier makes supply for a goods or services in return for consideration to a customer, and the contract ends. There are some other contracts also in which there is a continuous supply of goods and services without the need of a contract being renewed after a fixed interval. So the contract itself defines that the suppliers will keep on being supplied on a continuous basis unless the contract is revoked, cancelled, or nullified. So the rules are little different, but the basis are same. In respect of the time of supply for discrete supplies, it is the earlier of when the goods are being supplied, or when the services are being performed, or when the tax invoice is being issued, or when the advance amount is received, whenever it's happening. There's a little difference between time of supply for goods which are being provided with transportation and the time of supply rules which are being provided without transportation. So if give you an example, let's suppose you are a big manufacturer and you have manufactured some goods. So your contract says that you will supply goods as soon as they are prepared without transportation. The time of supply rules will be kicking into once the goods are being made available for your customer for his pickup. So that would be the date from where the time of supply will start for that particular supply. But if you have been contracted to supply goods by making them transported to a certain location, the time of supply will be the date on which the transportation begins. There's a slight difference between the day when the transportation begins and when the goods are being made available. So you need to keep an eye on this thing also. It usually happens for big consignments in which the goods move out on installment basis from the godowns or from the factories. So for each, you have to see that how much consignment has moved out, and for that particular consignment or for that particular batch of goods, the time of supply rules will kick into play. For services, the time of supply is when the services have been performed. So if you have started the services, the day when you perform the services, you have to match it with your other timing rules, which are the tax invoice, when the tax invoice is being issued and when you have received an advance amount. So any of these things happening earlier is your time of supply rules. I'll just share you with my experience over 1.5 to 2 years in Bahrain. So we have seen that the businesses do not consider, we have seen examples that receive of an advance amount, they do not consider as a time of supply rules. And we have seen that a lot of businesses have received 50% or 70% of the advance contractual value without even delivering. And the delivery of that happens after 3 months, 6 months, or even 1 year. So this is quite shocking, because if you're not reporting the receipt of an advance as your time of supply, you are understating your revenue model as per the tax returns. So that could be catched by the NBR, and they can say that your tax reporting is wrong because you are not following the time of supply rules. So, and one other problem we have seen in the business is that mostly the advances amount were not even recorded under the ERP systems, and the systems were not capable enough. This is another problem which caused a lot of problems in tracking the advance amounts which have been received. So to cut short, receipt of a tax, receipt for an advance amount, issuance of a tax invoice, or supply of goods and services, whichever is happening earlier, will trigger your time of supply rules. For continuous supplies, this is a little different. Apart from the issuance of tax invoices and receive an advance amount, there is a rule which is a little different from the time of supply of the goods and services. Now here in continuous supplies, the rule is that when the payment is due. So the continuous supply contracts are relevant usually to lease rentals, your rental of house, your EVA bills kind of thing, your management support or consultancy contracts in which there is an agreement that after quarterly interval or after 6 months, there will be a payment by a party X to party Y, and it will keep on going without the renewal of the contract. So you have to see that if there is a payment due date, and despite the fact on the payment due date, you neither receive an amount, you neither receive the payment, and you haven't issued the tax invoice, you still have to report on a rule basis in your tax return as a continuous supply contract, and that has to be reported as a time of supply under the standard rated supply. So that's quite complicated, and we feel that a lot of businesses do not still know about the correct time of supply rules, which are making their reporting time of supply. Got my hard cash, and that's when I should be reporting to the authority, which is little difference. The problem with this is that if you go to the next slide, there's a quite cash flow issue. So if you issue a tax invoice before you even provide the goods and services, or if you receive the advance amount without realizing the revenue for that, there will be a mismatch of accounting data and tax data. So this basic tax point overrides, and it overrides the cash point. So there you may have issued a tax invoice as a startup to your customer, and he pay you after, let's suppose, 6 months. So as in time of supply rules, you still have to finance the VAT from your own pocket because you have triggered the time of supply rules by issuing the tax invoice. You have supplied goods and services, and afterwards you issue a tax invoice, and you have a credit period of, let's suppose, 6 months or 3 months, which is quite normal in this region. So it means that this cannot go like this, because you will be paid for the value of services and the value of VAT only after 3 to 6 months. But you have to pay the VAT specifically to the government as soon as you file your first return in respect of your supplies which are happening. So the longer payment terms means a bigger cash flow gap for the businesses, because they have to finance. And in these period when there is difficulties in getting being paid, you'll try to reduce the financing. We'll try to reduce the aging so that you get paid instantly, so that you don't have to pay and finance your cash flow for the VAT and working capital purposes. Can we go to the next slide? So we have discussed about it. So the valuation is the next key point, which is quite troublemaking and which is now opening new avenues. So the consideration which you receive, the definition consideration has been specifically defined and includes the value of supply plus the value of VAT. So consideration is anything which is being paid in money. It can be anything which is paid not in money. So recently, the NBR has raised some guidelines on the retail and wholesale trading businesses, and they have clarified that if you are trading something on barter system, that you are exchanging your goods with the goods, you have to determine the fair value of the goods you are giving away, or you have to determine the fair value of the non-monetary item which is being exchanged under the transaction. So there are certain things. If you are providing certain goods and services for free, there is nothing free in the market. There are certain thresholds which you need to meet. In the Bahraini VAT law, the law has defined that the samples and gifts can be given up to an extent of 50 dinar per person per year, or to a total of 1,000 dinar. If you provide anything more and over and above this threshold, then you have to charge VAT in order to claim the VAT on those cost of goods that you have been supplying for free as goods, as samples and gifts. There is another problem which just was clarified during the last 3 months. So the relationship between the employer and employee, the NBR has clarified in its NFEQ that they are related parties. They are a connected person and they should be treated as a related party, which means that if you are making any transactions with your employees, if you're making any transactions with your internal staff, it has to be dealt with like you are trading it with a related party, and the value which is being assigned to that value, to that goods and services, should be the open market value. So if you are providing goods at subsidized rate to your staff, you have to watch the threshold. If you're providing something for free, then you have to see the threshold. But if you're providing these goods to your staff at subsidized rate, you can do that, but you have to do it. You have to pay the VAT to the government on the open market value of the goods at least, or at least you can give it at the cost which is there. One important aspect that I like to touch here, that recently the NBR issued a clarification in an FAQ that in all related party transactions, they expect that the fair market value concept will be adopted by the parties when they are assigning values, when they're charging between the related parties domestically and internationally. The thing which was quite exciting and which was new to the market was that the NBR stated that in all international transactions where the related parties are transferring and they're charging prices, if you don't have the fair market value models, then you have to follow the transfer pricing regulations which have been adopted in the OECD models. We'll talk about this thing later, but you can clearly see that the regulator is now looking into the aspect that the price being charged by you to your related party should be not something which comes as a decision making of one person, but it should be under the internationally accepted rules and principles, and it should be substantiated by the parties that the price being charged is the market value, which should be under the TP regulations which have been issued in 2013 under the multilateral tax convention under the OECD model. So I mean, give you an example that things are moving on more towards the corporate structuring and probably towards more documentation and probably into future compliances in the form of more taxes or more scrutiny of the transactions that are happening in Bahrain. Can you go to the next slide? So there's a concept of VAT inclusive and exclusive. Most of guys, you already know about it. So the lawmaker says that any price, the consideration that you receive should be VAT inclusive. You don't need to spend much more time. So if your contracts are silent, you do not negotiate your contract prices with your customers. That's a legal thing that you have to tackle it out of the VAT law. But the price that you are being paid for will be treated as a VAT inclusive amount. And if the amount which is not collected as a VAT from your customer, you may end up paying it from your own pocket. So we have seen a lot of businesses being hit by this cost, and especially if you have businesses in Saudi where there's a transition from 5 to 15%, be watchful on the contracts that you have. You should specifically cover yourself so that you have the right to charge to your customers at the prevailing rate and do not end up in paying from your own pocket in these difficult times. Can you go to the next slide? So we have talked about a lot on the basics and technical knowledge. Shakti, next slide. So the next important topic is the tax invoicing and documentation. I mean, as we have said that we have been doing a lot of reviews and a lot of return preparation, and we are focusing that you have to prepare correct tax invoices. This VAT is only about the documentation. If you have the correct documentation, everything is correct, and they can trail back to your financials. Nothing is a problem for you. If you don't have the correct documentation, at the end of the day, it's a headache for the business to prove the position they have taken the VAT return. So we will discuss about 2 templates about the tax invoicing requirement. We have been continuously over the period of time stressing that the market participants should seriously look into the documentation, and they should improve it and make it as per the VAT law requirements. So if you are, just to give you an idea that if you have any foreign invoicing, you have to do the local currency equivalent as per the CPP rate, which happened at the date of supply, or the alternatives which have been approved by the NBR. Debit and credit notes have to be issued. One big problem that we face still now is that a lot of people are still issuing debit notes in place of the tax invoices. Please note, debit and credit notes are the subsequent documents. They can only be issued once the original tax invoice has been issued. They only adjust the value of supply of the original supply which was mentioned on the tax invoice, and they can only alter that. Debit note cannot be solely used as tax invoice from 1st January 2019 and onwards, because it has a specific meaning which has been defined under the VAT law. Can we go to the next slide? The next 2 slides just give you an example of the templates of the full tax invoice and the simplified tax invoice. It's quite elaborative, and I think most of you people already know about it. Can you go to the next slide, simplified one? So the flexibility was there in the simplified tax invoice. So if you are making a supply to a customer who's not registered, or the very total consideration value is not more than 500,000, the law has given you flexibility to reduce the requirement of the tax invoicing and issue simplified tax invoice. This is the mostly cases for a lot of local trading businesses which have the local POS sales system installed at their premises, when you cannot publish or we cannot print the bigger invoices. So this is being helpful for them. Just keep in mind that if you issue the simplified tax invoices, it should meet the criteria, and it should be meeting all the requirements are there as per the article regulating about the invoices. I'll just share one example. We just saw one invoice of one of our clients. That invoice value was more than 10,000 BD, and it was issued on a simplified basis. So that's not the use. So you have to see the value of supplies on base-to-base basis. If it is more than 500, then yes, you have to consider whether the customer is registered or not, and then you have to issue simplified or full tax invoice depending upon the scenario. Can we go to the next slide? So we have talked a lot about the documentation, place of supply, time of supply. The next thing is compliancing. So as you know that in Bahrain, the compliancing was divided into 2 phases. The initial period, which was the transitional period, was from 2019. And this was a quarterly VAT invoicing period for the tax period, which were there. There were 4 tax periods from 1st January 2019. Some of the bigger businesses who got registered from 1st January were required to file 4 returns, and then there were some ones which were privileged to file semi-annual ones and then quarterly ones. But since the transitional period is now finished, so now all the businesses in Bahrain will have to file their tax return based on their annual turnover. So The annual turnover, you have to see that if you are making more than 3 million dinars, you are automatically being directed by the NBR portal that you will be filing monthly return. But if you are less than 3 million dinar, the portal will only accept your tax returns on quarterly basis. There is an option to change your portal from quarterly to monthly if it's being specifically asked to the NBR, and they can do that on a request being made to them. Recently there was a new clarification and new flexibility which came out, in which the smaller businesses which only got the revenue less than $100,000 less than that in a year, they can opt to go for an annual tax return. Instead of filing 4 quarterly returns, they can file annual returns. The update to that is that the NBR clarified that all those people who made an application before 31st March 2020 were approved to file the tax returns on the annual basis. Those who missed out the deadline can still do that, but it will be effective from 1st January 2021. So they still have to make the 4 compliances, and then from 2021 they will have to do 1 quarterly invoice, which will happen for 2021 and will be done on 31st January 2022. So the VAT returns are quite modern. They provide the tools for the payment in all different forms, from debit card, credit cards. Recently, the Bahraini government announced that even the payments can be made from Bahrain portal, Bahrain.ws portal. So that's a big breakthrough for all the non-resident suppliers who are registered in Bahrain, because previously they were required to have a bank account in Bahrain in order to make a payment. Now, any debit and credit card can be enough for making a payment despite not having local accounts, and you can make a payment of the tax authority to the tax authorities. This is something about compliance thing. I will move forward to the penalties just to give you an idea about the seriousness of the issues. Maybe in the last sections, we will not talk about the most important aspect, which is costing a lot of business a lot of money, which is the recovery of import tax. So if you go to the next slide, we see that there are certain rules which need to be met where you can recover the import tax. The import tax is the tax which has been charged to you and where that's ineligible to be recovered under the VAT rules. So in order to recover VAT, there are certain conditions that has to be met. So the conditions which include that you must be first a registered person and the VAT has been charged to you. So registered person is fine, but the VAT must be charged to you. So you cannot self-create any VAT and then claim the VAT from the government. We saw this thing happening in the initial days of the VAT implementation, where people were just putting themselves the VAT charge without they being registered for VAT, and they were collecting money. So you cannot recover VAT if the supplier is not registered for VAT. That's an abuse. That's something which is wrong, and it's a criminal offense as per the VAT law. So second thing is that, which is important, because as we discussed in the importation of goods section, that if the VAT is not being charged to you as a business and it is being charged to someone who got the clearance of the goods at the time of the shipment, then still you cannot recover the VAT. So the initial idea is that the VAT must be charged to you as a legal person and you hold the documentation. So if you don't have that, then unfortunately you have lost the cash flow and you lost the right to recover the VAT from your VAT return. Then the goods and services which have been acquired must be used in making further taxable supplies and used for business purposes. And they are not being prohibited in Bahrain. So you cannot import goods for making something which is prohibited, not allowed by the government to do. And you hold the documentation in your name, physical documents and original documentation, and the input VAT has not been specifically blocked. We re-stress that you do not have a valid tax invoice, you do not have the valid cost for custom documentation, you cannot claim. Here we want to substantiate that there is a lot of pressure on the AP side before processing the invoices, because if they do the job very well and they just scrutinize all these things as a part of AP process, and they do the scrutiny of the information of the tax invoices, it becomes a less headache at the time of doing the VAT return, because you have no invalid document which is being passed through the system which represents as a valid tax document for which you will be recovering VAT. You need to understand, if you're recovering a VAT which was not allowed to you, you will end up in making an understatement of the tax return, which is dealt as VAT being paid less, ending up in collection of the unpaid VAT plus additional charges and penalties. Can you go to the next slide? So if you see that in the next slide, we have defined the VAT input law as per the law, and then given examples which are blocked. So by the law, the lawmaker has given that all those goods, the non-deductible part of all those goods are those in which used other than in taxable business activity, the goods which have been prohibited, or the supplies or imports for the purpose of making exempt supplies. So these three categories you cannot recover the input VAT. Examples to that is that entertainment expenses, like the expenses which are being incurred on the staff and non-staff members on the accommodation, hospitality, food, drinks, etc. Recreational activities on personal things like functions, gupkas, events, stuff like that. Goods and services used by employees free of charge and for their personal use unless they're required by law, and vehicles related expenses. We will deal with these last two in more detail in the next slides, just to give you a highlight on what things are not proved as valid input VAT. So if you go to the next one, we'll see that there were some few clarifications which came out in the last 3 months, and which says that if there are certain expenses which you are doing as part of an obligation under any other law, then the VAT in respect of that can be claimed. So if you see that there are certain expenses which most of the businesses have to do, which includes like medical insurance, accommodation, food, traveling, and there is a lot of VAT which is being incurred there. So what you do with these? So as per the VAT law, if you can substantiate that the expense which was incurred was as per the law, then you can recover the same from the VAT. We will talk about the insurances a little further, and I think we are getting a question also on the insurance, that whether the insurance can be claimed, the VAT on insurance can be claimed or not. So the answer to that is that we need to see, and we will answer that in the last session. Then there are expenses in relation to motor vehicle and mobile phones. So when you see that there are motor vehicles and mobile phones which are usually provided by the employees for the ease of the businesses of their staff. So in that case, there is mixed use of this service for business and personal use. In this case, there have been some specific guidelines which have been issued recently under the FAQ section of the NBR, and they say that if you are able to demonstrate the actual usage or of the consumption to the extent of business, you can claim that. So the cost must be allocated between business and personal use on a fair and reasonable basis. So if you cannot substantiate that, then the lawmakers have provided a simplified approach in which you as a businessman are allowed to claim the VAT on a fixed input recovery rate of 40%, and for mobile phones, fixed recovery rate of 60% on all your motor vehicles and mobile expenses. If you see that, the 40% is in respect of the motor vehicles and related expenses, which include any repair, maintenance, insurance, and all related expenses. And in mobile phones, the same applies. One important thing is that for mobile phone recovery bills, there is one additional condition that you can only claim if the business uses more than 50% of the total consumption cost. If that's not the case, then you cannot opt for it. And these conditions are not valid for prepaid mobile costs, or prepaid vouchers for the telecommunication cost. Can we go to the next slide? So having dealt so, most of the businesses already got registered. The smaller chunk already got registered from 1st January, and they have already filed the returns. So there's just small talk on the pre-registration period VAT. So this is relevant to new business, new startups who incur huge cost for their VAT. Just understand that if you are into a new startup and you are making huge costs in the VAT, you can still recover the VAT in your first VAT return, which you file immediately after your registration, in respect of the goods or services which are acquired for goods for the last 5 years, and for services at least 6 months before the registration date. But the only thing is that the goods should be supplied before the date of registration, and the capital asset at the book of the registration value. The one important condition for this thing is that the goods should not be specific, and goods service should not be specifically blocked, as we have discussed in previous slides, that if they are being part of the business process used in the taxable supplies, you can still recover the same as part of your pre-registration VAT cost. The next slide says about the post-registration input VAT. It's a normal rule. You can claim it in your VAT return as they are incurred. The lawmaker has provided a period of 5 years from the end of the year in which it relates, and that if you have the valid tax invoices with you, you can still claim the VAT from your VAT return. That gives you another benefit, that if you have receiving some faulty or invalid tax invoices from your suppliers, you can still hold the invoices and you just wait for another tax return period or tax period. And once you get all the invoices, correct invoices, and you can go and claim VAT once you are sure enough that you are now holding valid tax invoices. So this is about the recovery of VAT, some rules and conditions on that. Go to the next slide. Shakti, go to the next slide. So just penalties, we just wanted to give you a highlight on the penalties. You all of must have been knowing that. So there are some administrative and criminal tax evasion penalties which are there. I just wanted to mention here the last 4 penalties, which start from last 5 ones, which are the failure to cooperate with tax authorities, update in tax registration, display prices as inclusive, failure to comply with tax invoices. We have been re-stressing it again and again that invalid tax documentation provides an option and provides an opportunity to the tax authority to come back and charge you a penalty which can go up to 5,000 dinars. So please take these things as seriously, because if you are using those things, it is a burden on you as a businessman to prove that the documentation has not been used otherwise, or you have not been used a document which is valid as per the tax invoice. One thing about the Bahrain white law is that there were some tax evasion rules also which were totally different. Can you go to the next slide, which clearly mentions that despite the administrative charges, there are some criminal offenses also. The next slide. So you see that even the last 4 or 5, they are stressing upon the recoverability of import tax, issuance of invalid tax invoices, and charging VAT, which is against the chargeability rules. If you do that, they can even catch you and charge you with tax evasion, and which can end up into 3 to 5 years of imprisonment and penalties up to 1 to 3 times of the tax. So these are the hardcore penalties, and it tells the seriousness of the issue and the seriousness of the authority. As we are moving into difficult times, it is very important to understand that if we are not doing things the right way, we are giving an opportunity to the authorities to come back and see our compliance, see our records, and then at the end of the day, you may end in paying it more cost in the form of penalties and additional charges, which we will see in the coming slides. So can you go to the next slide? So we have talked a lot about the this time of supply and all these rules. One important concept I want to discuss is about principal and agent, which has been quite confused and quite not correctly followed in the region. So there are a lot of businesses which are now paying on behalf of someone else. So there is a concept of working as an agent. So if whenever you are into an arrangement where you are only paying on behalf of someone else, where the original cost is not yours, please note this is not a supply as per the VAT law, and you are not required to report that, because you are only financing the cost as a financer and you're not the contractual party to the agreement. If that is the case and you are only acting as an agent, your services which are being reported here are only to the extent of the agency services which you have provided to both parties, and you will only report that service agency commission in your VAT returns. The cost that you receive and you pay further will become disregarded and out of scope for VAT purposes. Now, this is a little different from the reimbursement, which will come in the next slide. So if you see in the next slide, there's a difference between cost recharges. So reimbursement is in all those cases where someone is acting as a principal. So we have seen that a lot of businesses in the market who are acting as a principal, or they are doing a facilitation business for someone else. So we have seen that they are facing difficulties when they have to recharge the cost. To give you an example, let's suppose someone provides me a service in my name and I have a tax invoice in my name, but that service was only provided on the contractual term and I have to recover the cost from someone else. So since the documentation follows in my name, and in order to take it out from my books of account, I have to recharge it back to someone else. This is a classic example of recharge or reimbursement of expenses. So this reimbursement of expenses should be taken differently from the tax meaning of the reimbursement, which is usually taken as someone else is being reimbursed for the expense which is being paid. So we have seen in a lot of holding companies that they are recharging the cost allocations, management recharges, salary recharges of their board of directors, and they say that this is not a supply. But as per the VAT law, the clarification which came out, you have to see on case-by-case basis, and eventually it may end up in making a taxable supply on the holding company part. And you may end up in getting registered and paying VAT on the supply which you are thinking as a disbursement, but it become rather a reimbursement of expenses. This is a pure equity and pure holding company scenarios. I mean, we have seen that the board director salaries, the common pool expenses being dispersed out to the subsidiaries on allocation basis, which are being treated as a revenue and cost with no profit and no loss model, but still in taxable. For VAT purposes, it's a taxable supply and a taxable purchase. This is just to give you a brief on the principal agency relationship, and it should be dealt properly with the consultation of your legal department or your tax advisor. So having said that, so we would like to move on to the topic about the COVID and the current implications which are there right now. So you see that we are all facing the problem, and we are seeing hardship in doing the business in the market, and this is because of a lot of sanctions, lot of lockdowns in the region. It has severely affected the market, and most of the businesses are now facing a lot of problems, especially in their cash flow liquidity, in continuation of their business, and managing working capital for financing their future operations. So just, I mean, this is kind of a special scenario. This is kind of a special situation where a lot of businesses are now feeling very difficult that the things that they were used to do previously are no more effective. And it is becoming really hard. Let's accept this truth that once this period goes away and the pandemic settles down to acceptable levels, then the regulators and the countries will need more financing from the businesses, and we are anticipating more taxes being coming into play, so that the shortfalls or the spendings being done on the government by the government on their masses or on their public, on the additional health budgets, they need to be replenished. So we are looking in that the business should see this as an opportunity to look into their affairs which have already been done. Lot of businesses can look into different options available to them by the VAT law which are available. Most things include, like, you should be doing a health check saying where you are identifying your whole business processes for any unclaimed VAT which just got messed up because of AP system or AP processes. You need to do an analysis on your debtor policy. Can you afford to give more credit period of the current credit period? Can it go further, or you need to shorten it? You need to evaluate your existing AP processes, that how they're processing the payables, how they're processing invoices, what is the acceptability level. The most important thing we are seeing the current trend is that most of the businesses now converting into the business groups, which are the tax groups, and they are getting the request. They are requesting the NBR for approval of tax groups because they want to avoid the intermediary cash flow issues by combining different group of entities which are under the common pool. Then there are certain benefits which are available in the VAT law itself, like you can request the NBR to make the approval of the payment of the VAT due on installment basis, but that's quite lengthy process, because it's usually more effective when you have huge penalties and payments you have to pay to the government, and then you make an extra request that you can pay that in installment basis, on month basis, on quarterly basis. Then you can also look into changing your compliance period. If you are into a quarterly period, you want to recover the VAT which is lying in your input tax invoices by converting from quarterly to monthly invoice, monthly tax returns, so that it's the working capital period fastens and you recover the VAT on monthly basis instead of waiting for the quarterly basis. You can look at your recovery ratios. You can look on the exemptions which are being available to evaluate that the standard apportionment formulas which are being provided by the NBR, are they beneficial to you, or you can adopt some other approach or some other basis which are more beneficial or more practical to the scenarios you're working into. And then at the end of the day, you can evaluate the scenarios of encashing your VAT refunds if you are into zero-rated industry, especially because we have seen the aviation industry, we have seen the travel industry, we have seen the hospital, what you call that, health industry. So they have incurred a loss of procurement, and their services are zero rating. So traditionally, what the businesses are reluctant to encash their refunds, and they tend to carry forward the VAT. So in this difficult time, it could be a better to make an evaluation that if the AP process and your VAT reviews are being done very tight and there are no loops available, so you can end up in our requesting the NBR to process your refunds, but that brings cost of NBR audits. So if your systems are ready enough, you can still do an option, and then that can end up in better cash flow, so that you can back your hard money back from the NBR. So these are some tools which are available and which can be worked out based on your strategy and based on your working needs, and that can be helped out by the help of your consultant or with the help of your legal advisor, that how you want to proceed with further. We can help you out in all these services if you want us to do that. Now, having said this, we conclude with the VAT part, and I try to be a little fast on the things, because I wanted to cover the economic substance requirement regulation, which is just standing on our face right now. The compliance is on 30 June. I want to discuss more about that. So we'll move on to the economic substance, and we'll be happy to take questions and answer them as soon as it's done. So economic substance regulation, this is a new concept, a new thing which is coming in the market. I would like to give you a brief of what is this and why it come into Bahrain, by giving a small synopsis, a small summary of where it started and how it ended up in Bahrain. So as you know that we are all part of one world, which is called Earth. So there are certain regulators which are there working internationally about the economic coordination, country to country level, communication and all those things. One of the department is United Nations, which are under that. All the member states are under the charter of that. So the United Nations have different ancillary departments which are working under that, and one of that was the OECD, so which stands for Organization of Economic and Economic Cooperation and Development. So this department was set up for the international trade to do smoothly, where the different countries can coordinate with each other. So under that organization, different kind of rules and regulations being set up in order to standardize the international trade between different countries. So in 2013, there was a project which was called Multilateral Tax Convention, which was agreed, according to which the countries agreed that the businesses, especially the multinational businesses, have the capability and have the ability to manipulate the financial results from one country to another country, and they tend to take benefit of tax benefits in different states by parking their revenues in the low tax jurisdiction areas. So as part of the OECD MTS program, the project called BIPS was approved and ratified by all the countries. So the project was, the BIPS stands for Base Erosion Profit Shifting. And the main idea behind base erosion profit shifting was to counter all those measures in which the multinationals were using and abusing the system and parking their revenues from one jurisdiction to different jurisdictions. So it included changes from the legislation level, framework level, documentation level, advisory level, consultation level, and dispute level. So as part of the BIPS, there were some 13 points which were approved and agreed by the countries, and they were being followed by all the big countries, especially G8 and G20 countries. But the biggest hurdle which the BIPS and OECD faced was that not all countries were adopting the framework. So in order to strengthen the measure, the European Union in 2018, they issued a list in which they blacklisted few countries for not adopting or not following the international practices on tax transparency. And unfortunately, Bahrain was also part of that, part of the list. So as soon as that we realized that we are being parked into an unlikely blacklist, Bahraini government stood up and said that we will implement certain minimum criteria for the BIPS project, so as to avoid any future blacklisting. So blacklisting means that there were some priorities of the foreign direct investment, some visa processing, and all those things. The privileges were there in the European Union, it will go away. So in 2018, Bahrain joined the inclusive framework of the BIPS under OECD model, and they agreed to implement at least the 4 basic minimum action points. They are listed on the right side. You can see that they are action 5, 6, 13, and 14. And they agreed that they will implement the same in the coming years. We have seen a lot of activities from the international regulators. We have seen that the OECD people are actually visiting Bahrain and guiding the local regulators, which is the Ministry of Finance, Ministry of Commerce, the National Bureau of Revenue, the CBP. They have all been regulated and educated to implement this thing. As of now, in 2018, and Bahrain announced the economic substance regulation, which is in compliance of Action 5, which states the countering harmful tax practice more effectively and taking into account transparency and substance. So the law was announced in 2018, and it was announced under 2 directives which were issued by one Ministry of Commerce under memorandum under MO 106, and by the CBP under different directives. So the regulator announced this thing that the government of Bahrain intends to document the substance of the businesses in Bahrain. So as an action point 5, all the economic substance was regulated through Ministry of Commerce and CBP. So they gave a list in the regulator in the orders that if you are into some specific activities, you are required to make a disclosure to the government of Bahrain of your economic activity and substantiate the same to the authorities. So they divided the whole industry into 2 set of groups. Those which are coming under the regulated CBP model were the banking, financing, insurance, investment, and fund administrative, which were under the CBP rule book 2006. And the second set was those which were coming under the Ministry of Commerce, and includes all those activities which are falling under distribution, service, head office, holding, leasing, shipping, and intellectual properties. Now, so the deadline as per the board directive was that if you have your financial year end closing on 31st December, you will have to make compliance by 31st March, which is within 3 months of the end of your financial year. But because of the COVID, they did not implement or enforce the deadline on 31st March, and they gave an extension up to 30th June 2020, which is approaching now in next 9 days. One clarification which we like to give, that this return compliance extension was only available for Ministry of Commerce through a public through private emails which were being circulated to people who are required to file the full tax return, the full economic substance returns. In respect of the CBP regulated businesses, this compliance extension was not available exclusively as a public information. It was only provided to those who requested for extension on 31st March 2020. So this is the background of what is this economic substance return, and what does it require right now is that the new this is applicable on all new CRs which came into being on 1st January 2019. It is applicable on all CRs which were there on 1st July 2019, and it is on CBP licensed CRs which are there on 1st January 2019. So what is it? We'll go to the next slide and we'll talk about what is it. So the economic substance regulation looks into, Shakti, can you go to the next slide? So the economic substance regulation looks into a declaration or a full return filing to the Ministry of Commerce, for which they are looking for 3 basic things. First thing is that, are you a core income generating activity? So the core income generating activities are all those activities which are being notified by the Ministry of Commerce in their list, that if you are falling under those activities, as per the ministry, you are a sensitive business and you have the potential of manipulating or parking your revenues right and left without having any economic substance to justify the same. The first thing is the notification in terms of identification of the core income generating activity, the core activity which you are doing. Second is the adequacy test. The adequacy test is quite subjective thing, and the law requires that you have to prove that when you're generating a core income generating activity, or when you're receiving a revenue from an activity which is your core activity, you have to substantiate that in order to earn that money, you have all justified cost as approved by the international standard to substantiate that the money was made out of that investment. So they think that you need to have adequate qualified people, you need to have your physical place in Bahrain, you need to have adequate expenses being incurred in order to earn the money which is under core income generating activity. And the last test is the management test. So here the management test means that you have a qualified management to run the business as a business who is conducting the core income generating activity. And when they say about the eligibility testing or the management test, they think about that the management, which includes the top management board of directors, they are fit and proper, they are qualified, they are meeting regularly, they do all the decision makings at the end of the regarding the core income generating activity in Bahrain, and they comply with all the requirements which are there as per any other requirement which are set up in the set up by the Ministry of Commerce or by CBB to be followed in order to be compliant with the regulations in Bahrain. So these three tests will intend to test your revenues models, your compliance with code of corporate governance, your compliance with internal audit policies, your compliance with external audit, your compliance with IFRS, your compliance with Ministry of Commerce notification on meeting regularly, the addition or exclusion of top people notification of that, the existence and premises location that the activities being carried out are being done through proper place, physical place, which are here, the actual meetings which are being done by the ministry, by the management in Bahrain, and the strategic decisions that are being done and taken. You need to substantiate that in the form of minutes of meeting, in the form of decisions, memorandum, which is being communicated in the board meetings to the masses or to the Ministry of Commerce. So this is quite an elaborative or subjective domain here, where people have to substantiate what they are doing, and they need to prove that the income which is being parked in Bahrain is being substantiated by the underlying cost, by underlying capacity, underlying capability, underlying physical place, and the intention to do business from Bahrain. So on the right side, you see that there was some list of activities which were being issued by the Ministry of Commerce, that they are looking for these activities to file the economic substance return for due on 30th June. All those entities which are not in this list will still have to file a notification intimating to the authorities. Ministry of Commerce said they do not qualify, and they have to provide certain information regarding the physical place, the ultimate beneficiary ownership, the tax residency of the ultimate beneficiary ownership, international partners, and the declarations that they comply or they do not comply with the regulations at all. This is quite a hard thing to come, because this is one step towards more documented environment, and the non-compliance has been very heavily proposed very heavily to be fined. And you see that there are measures that Ministry of Commerce can suspend your CR, they can strike out your CR, deregister your company, or they can impose penalties which can be which can range from 1,000 dinar per day up to 100,000 dinar to a max, or a mix of all those things. The idea behind here is that the regulator or the Ministry of Commerce is now documenting the actual economies of the country, and then they want to share the same information with the international regulators. So this end up in making you disclose that what are the operations and why you are doing the operations. To give you an example, let's suppose a holding company in Bahrain, they have no operations in Bahrain, but they have a big management fee being recovered here as, let's suppose, 1 billion dinar. So in order to justify that, there is no underlying cost and no justification. So the lawmakers are taking this view that the whole intention behind is to change the location or relocate the money from some high jurisdiction into Bahrain just to avoid the tax purposes. So the purpose here for the economic substance is to give this information to the international regulators, that if a holding company, shipping company, distribution company is having huge revenues here, how they earn the revenues. This is one step further. If Shakti, can you go to one slide back? This is part of action point number 5. And if you see that there is an Shakti, can you go back one slide back? So if you see that there is action point number 13 also. So we discussed about transfer pricing document and country by country reporting. So the government of Bahrain has actually agreed that they will be bringing to transfer pricing and C by C reporting, which are the international standards of regulating and documenting the local businesses. So we all see that these are the steps towards a more documented corporate market, which may pave the way for the future taxes, which could be any kind of taxes to come and kick into the market in the future days. So we have to take these things very seriously, because the government is now moving towards more documentation. They're asking you to prove that the activities you are doing, are they justifiable or are they approved. One last thing I would like to say that there are certain non-passive things, there are certain passive things which are being reported in your financials, but they're not approved there. So the Ministry of Commerce is taking the view that if you are, let's suppose if you have given a loan to your related party, and that loan is being provided as an related party credit facility, you still qualify for being a financial service. So the clarification is that you have to substantiate that why the subsidiary and why the holding company did not go to the commercial banks and why they arrange for the loans between themselves. So this is kind of an elaborative thing, a kind of a sensitive thing that you need to disclose, that there was a loan arrangement between the related party and the holding company, and why did we not go to the commercial banks to do that. So you have to make a declaration under an activity which could be a banking activity and it could be a financing companies. These are the things we have to take care of and which are very sensitive. And lastly, the information that is there, it should match with your financials. So if there is an income which is coming for which there is a no approved activity, so that could end up in a lot of problem, because then you might not have updated your database with Ministry of Commerce or CBP, and this might be taken as an understatement of your activities to the Ministry of Commerce, which may end up in some penalties which we cannot right now confirm. But yes, they are looking for this kind of information, and they want your financials to be reported in which your core income generating activity is being substantiated with the adequacy and management test. So that's all from my side. I tried to be very quick and try to cover as much as from the local legislations. We still know that there are a lot of guidelines and a lot of things which are coming in due play, and we plan to do another session on this thing in the coming days, and we will let you know on how and when we want to do that. Like lot of clarifications on real estate, wholesale, export, telecommunication, retail industry, tourism industry, education sector, which came out. We try to cover them as part of the basic and technical material. And do let us know if you have any questions regarding the same, and we'll be happy to answer. Thank you very much. We're happy to take any questions. Shakti, over to you.
Hi, hi Naveed, and yeah, we have a lot of questions actually. So due to technological issues, Mariam is here with me because there were certain issues that we couldn't deal with in terms of audio, and we had this come up through audience as well. So we thought we could sit up not very close to each other due to Corona, but at least a little close to each other, and try to answer the questions. So she will. We have a couple of questions in Arabic as well. So Mariam will take care of those. Meanwhile, there's an interesting set of questions that I would like to ask Naveed. Naveed, there is a question that comes up about ESR. They want to know about application for ESR. So there's a question that says, how can we apply for ESR? How can you assist us? Is a consultation possible?
Yeah, we can do that. I think we will connect you with in private, and we can connect you and tell you how we can help you with the ESR. Yes, there is an eligibility analysis that has to be done, that whether you have to file a notification or whether you have to file a complete return. We will connect with you in private afterwards, no problem.
Right. And then there is a question that says, how do I determine if I need to register?
Register for what? VAT?
For VAT. For VAT.
Okay. So there's a registration threshold which was given by the VAT agreement which was signed, and you have to see if you are making more than 37,500 dinars in the last year, or you're expected to make in the next year, and you are resident, then you are only required to register as soon as you touch that threshold within 30 days. But if you have having the same threshold breached in 2019, then your registration requirement was on 1st January 2020. You need to go and register. But if you are a foreign non-resident and you are providing services in Bahrain, then you cannot look into the registration thresholds. Your registration liability is immediately as soon as you make one BD supply in Bahrain.
Right. Thank you, Naveen. And a couple more interesting questions. I would just like to pick on one thing that says, how can I verify that the supplier charging me VAT is registered for VAT with the NBR?
So this is quite a good and normal question to ask, because we have seen that in initial days, a lot of suppliers were fakely charging VAT and were taking the money to their pockets. So in order to cater that, the National Bureau of Revenue has provided an electronic VLOOKUP tool, and in which you can put the number which the supplier has provided you on his tax invoice and verify whether the details matches with that. If that matches, yes, he's a supplier, and then you can pay the VAT. But as part of the whole implementation process, we have been advising, and we advise the question person asking the question, it is always advisable to collect the VAT registration certificate of the supplier as a first step to update your master data, so that for future compliances you don't have to go and look into see. Look, if he is making a forged or making a forgery in charging you VAT, this is a criminal offense subject to a very big penalties and fine. But you should also be responsible to check that the VAT which is being charged to you should not be claimed by you unless you have done your testing and clearance from the NBR. That you can do from the online tool. It's available, it's free of cost.
Oh, okay, right. Certainly insightful, Naveed. There's one more question also. Oh, as I see, there are more questions coming. So there's an interesting question that says, it's a basic question. He's asking about registration for VAT group. So how can I register as a VAT group?
So registration of VAT group is quite a big exercise in which you have to prove the common controls of all the participants who intend to apply. And there are certain criteria you have to meet, which can be common shareholding, common operations, or there could be significant influence also. Once you can establish the common control, then you can make an application to the NBR requesting for an approval, and then you can only register for tax group. Please note that the idea of approving or getting a tax group approved is not an easy one, because once you are done with the tax group, you cannot do individually things which you are doing in your individual VAT returns. So we have seen a lot of problems where the individual VAT returns need to be changed, need to be amended. But this can only be done after a proper consultation and doing a pros and cons review of your existing business model.
Right. Okay. And now I'd like to hand over to Mariam, because there are a couple of questions in Arabic as well. So probably Mariam can take it over.
سألنا سؤال يقول من يحتاج يسجل الضريبة؟ وهل يعتبر صاحب حساب الانستغرام لبيع مختلف أنواع البضائع من هاي الأشخاص اللي المفروض أنهم يسجلون؟ إيه، مثل ما شرح نفيد في البداية، أي شخص قاعد يسوي بزنس وقاعد يطلع منه ربح لازم يسجل حق الضريبة. هو مو لازم يكون عندكم CR عشان أنتم تسجلون. أي شخص سواء كان شركة ولا شخص عادي لازم يسجل حق الضريبة. إذا محتاجين مساعدة we can help you. أوكي. في سؤال ثاني يقول لما نحسب التوريدات السنوية هل نحسب وياها حق الفروع كامل؟ مثلا الشركة عندها كذا فرع، فهل لازم أحسبها كتوريدات سنوية؟ إيه. في حال شركة عندها كذا فرع لازم يعني من نسجل فرع واحد فكلها الشركة تكون مسجلة وكلهم لازم يطلعون proper tax invoice.
Right, and the most important part of any Q&A round is people get, all enthusiastic and they want to know more and more and more. And I see it on the board right now. I'm getting more questions. So now I'd like to bother you again with your permission. So there's a couple of questions that have come again. It says, we made invoices for the month of July, August 2019. We received funds Feb 2020. Unfortunately, the client deducted some amount from our invoice. So what do we do with these deductions?
So you as a customer, there as a customer or as a supplier, they issued the invoices. If I'm not wrong, they issued the invoices. So in that case, first of all, they have to pay VAT as per the information which they have submitted on the tax invoices. If there has been some adjustment or some deductions which are being done by his customer, they have to issue a credit note to reflect that. But you need to see that the credit notes are only valid if there is any change in the value of supply or a change in any consideration which is in respect of the value of supply. So if the deductions have been made with the just as a discount being given or some other thing, they have to be documenting that, because the supplier can only change the value of supply if he intends to. If this is just a cash flow issue, then you cannot do anything. But if this is something which is related to value of supply, they are agreeing to different value and you are agreeing to different value. If you agree to their value, you have to issue a credit note to reduce down the value of supply, so that the VAT which you have paid to the government is adjusted downwards.
Right. And while you've just kind of wanted more information with regards to this, the person asking the question has said it's a supplier.
Yeah, it's a supplier. He's a supplier, I can understand. So he must have issued an invoice for, let's suppose, 100 dinar, and he has paid 5 dinar. So his time of supply is as soon as he has issued a tax invoice. But he got back the payment which he was being made. Let's suppose it was 50 dinar. So now we need to see the reason why he has been paid less. So if the 50 dinar is being paid because of a discount, then the supplier will have to issue a credit note. But if the 50 BD has been deducted just for some other litigation issue or just as a cash flow adjustment, then there is not an issue, because now the supplier is not changing the value of supply and the customer is only adjusting the cash flow in respect of the settlement. So there are two different things. You can write to us, we can give you an opinion on this thing, no problem.
Great. Hope that answers your question, Mohammed Suhail. And yeah, we have another question that says SPC Co can be registered in ESR, and what is the process?
So SPC is one form of registration. So any entity which is registered in Ministry of Commerce will have to evaluate their registration as per their CRs. So CR, when we state that, it includes BSC closed, BSC, WLL, SPC, or any other form. So any entity which is a legal entity registered with Ministry of Commerce will have to see their eligibility for ESR return. I hope this answers. So SPC people are one single person company, but they may have approved activity of doing shipping company. So yes, they are covered. We have to see at the activity level.
Right. And there's another question that says, do we need to charge a margin for reimbursements?
So this is not a VAT question. This is more like a business question. So you are asking me that whether we should charge any profit on my price. We are saying that if you are recharging something, you have to see the value of the supply. So any price that you charge to anyone is fine for us, unless it is not a related party. So if you have a cost of 100 dinar and you want to charge it out to someone else, you can do it 100 dinars. This is perfectly possible, because the merits of doing business is in the hands of the management. They can allocate any cost. The only catch here is that in related party, the cost should not go below the market value. So let's suppose you have bought something like you bought a furniture for 100 dinar, and you are giving it away to your related party at 20 dinar. So the lawmakers say that you have to see the related value, you have to see the fair market value testing when you are making, and at least the price which is being charged should be the cost which is being charged to you. So it gives you an equal position. Even for the management services, even for the management services, there's always a cost which is built up inside. You do not charge anything out of the box. There is always a basis, and the lawmakers always say that if you are recharging something, the basis should be at least the cost. And if the cost is not determinable, then it should be the fair value which is there in the market.
Great. Right, Naveed. And there's a question that I think this person is closely associated with Facebook. So it says, how does RCM work when it comes to importing services from outside Bahrain like Facebook, and how is it calculated?
Okay, so I understand the question. Let's suppose someone is doing an advertisement for you on Facebook. So they are doing trending, and they're doing your marketing on Facebook. So you engage Facebook as a business. You do not use Facebook as a user. You engage them as a supplier. So the price which is being charged by Facebook to you, or an invoice, will be the value of your imported services. So let's suppose they charge you monthly of 100 dinars and a yearly of 1200 dinars. So if you are into a quarterly business, you will have to report your invoices of 300 dinars as your imported services, and on which you have to charge VAT and then claim it as per your VAT recovery ratios. If this 100% taxable, this will be just a accounting entry. So this is not only related to Facebook. This is relevant to all imported services, which include Facebook, LinkedIn, subscriptions, licenses. If you have imported some foreign Windows license or Office on corporate basis, they are still subject to reverse charge because they are dealt as an import of service. Licensing is an import of service. You have to treat it as an imported service. Your ERP, your Dynamics, a lot of things come into play. Your international security solutions, something like that, they're all import of services, and the list is very long.
Right. And so the question that you answered earlier with regards to the invoice raised for July, August, September. So he's gone back again. So he says he's a supplier. So his concern is we raised invoices in July, August, September 2019, and the VAT returns made and the payment has also been made. Later, the client has said the invoice should be inclusive, not exclusive, and they paid invoice amount only, which is VAT not paid. So VAT treatment, can you please explain?
So this is classic example of something which is not agreed in a contract. So if the customer is saying that they will not pay the VAT, so eventually they will have to reduce the value of supply by issuing a credit note to the effect of the value of VAT, so that the VAT amount which is being collected as a value of supply will go away, and the value is collected on the value which is determined on the fraction of formula, which is the amount received divided by 105 into 5%.
Great.
So just take the email. We will reply back on the email also, no problem.
Right. Okay. So he has another instance which talks about certain figures where he talks about raising invoices, say example 3,800, and suppose we raised 4,000 BD due to some deductions. We changed the value to 3,800, but wrongly the client has transferred BD 4,000. So what will be the treatment for this remaining 200 BD?
It's a cash flow issue. It does not have to do anything with VAT.
Right. So I think that marks the end of the questions. I think we can wait for a couple of minutes if people have more questions to put up. But yeah, I think that marks the end of the questions that we have so far.
So we will answer all those questions we have received over emails separately, and we will do that in a private emails to all the clients, so that they're satisfied. So we have tried to answer as much as possible within the limited time. You guys must know that there are a lot of talk about. I mean, we did not touch a few topics that we intend to do in our next session. Just stay tuned, and we will get back on other updates. Over to you, Shakti.
Right. Yeah. So thanks a lot again, all the attendees for attending this, and we as Grant Thornton would like to head to the next level. If you have any questions in mind, please feel free to seek assistance from our tax experts. So we have your, we have the email addresses right in front of you. So the person who's been the panelist so far, all again talking about so much with regards to his experience in the past, helping with taxation in GCC and all across the globe. So his email address is mohammad.naweed@bh.gt.com, and someone who's just stepped in and who's already doing wonders in this field, tax in the local market. That is Mariam Marhoon, who's already answered a couple of questions with regards to Arabic. You have her email address as well, mariam.marhoon@bh.gt.com. We have an increasing number of service lines that we have approaching us. So anything and everything that you guys want to ask us, please feel free, don't hesitate. And we look forward to meeting you guys on the next webinar. And until then, I know we have technological issues, but please let's maintain social distance. Right? This is Shakti and
thank you.
Thank you, Naveed. This is Shakti, Naveed, and Mariam on behalf of Grant Thornton signing off. Thanks a lot, all of you guys. Enjoy. Stay safe.